You have 30 seconds after you get your first dividend before most investors make the wrong move, one that silently kills decades of potential growth. They cash it out, spend it, let it sit. And just like that, they've unplugged the single greatest wealth machine available to regular people. Here's the crazy part. Over 90% of investors only ever use one type of compounding, but there are four, and when you stack them together, something wild happens. Imagine turning $100,000 into $58 million without day trading, chasing meme stocks, or gambling on crypto. It's real, it's data-backed, and you're about to see exactly how it's done. This is the difference between financial freedom and the middle-class trap, between building wealth quietly or spinning your wheels for decades. And right now, it matters more than ever. Markets are noisy, inflation's eating your savings, and most people are sitting on strategies that peaked 5 years ago. But you're about to learn the system I call the 4X compounding engine, a repeatable process that builds income, wealth, and freedom over time. And there's one simple decision in this video that can shift the entire trajectory of your future net worth. Let's get into it. All right, let's start with something almost everyone overlooks. Most investors don't realize this, but every time they take a dividend as cash, they're slowing down the single most powerful compounding loop in existence. They treat dividends like a mini paycheck instead of what they really are, fuel. When I first started investing, I made that mistake too. I'd see a few $100 hit my account and think, nice, free money. What I didn't see was the opportunity I was killing each time I let that cash sit idle. Because when dividends don't get reinvested, they stop multiplying. It's like watering a plant once and wondering why it never grows again. Here's where things flip. When you turn on dividend reinvestment, often called DRIP, every dividend automatically buys you more shares, and those shares start earning their own dividends. It's a chain reaction that builds on itself month after month. Let me prove it with real numbers. If you took $100,000 and split it between SCHD, a dividend-focused ETF, and Realty Income, a stock famous for monthly payouts, here's what happens. Over 30 years, that same $100,000 quietly snowballs into roughly $3.7 million. No timing the market, no trading. Just the math of compounding doing its job in the background. Now imagine the opposite. Same $100,000, same stocks. But you take dividends as cash, your growth curve flattens. You make progress, but it's slow, linear, and forgettable. Here's where people mess this up. They think they'll remember to manually reinvest later. They won't. Life gets busy, emotions creep in, and those idle dividends become wasted potential. So the move is simple. One click inside your brokerage. Enable DRIP. That's it. Set it once and let your portfolio start scaling itself. This is the quiet, automatic engine behind every millionaire investor's story. And it's the first lever of the 4X compounding engine. Now here's where it gets interesting. Timing really matters. Here's something most investors never think about. When you get paid matters just as much as what you get paid. It sounds minor, but the timing of your dividends directly affects how fast your reinvestment loop spins. Think of it like planting seeds. The more frequently you plant, the more often you harvest and replant, which means your wealth grows faster. This is where monthly dividends quietly outperform quarterly ones. More reinvestment cycles mean more shares, more dividends, and more compounding speed, all happening behind the scenes. Let's go back to Realty Income, the poster child for this strategy. It pays dividends every single month, not every 3. That means investors get 12 chances a year to reinvest and compound instead of just 4. Over 10, 20, or 30 years, that extra frequency creates a serious edge. In fact, when you compare Realty Income's long-term reinvestment growth to a typical quarterly dividend stock, like SCHD, you'll see something surprising. The monthly payer builds momentum faster. Same amount of capital, better cadence, stronger snowball. Here's where people mess this up. They focus only on yield or stock price and completely overlook payment frequency. But over decades, frequency becomes force. So what's the play? Build your portfolio with at least one high-quality monthly payer. Not because it's trendy, but because it accelerates the entire compounding machine. Monthly payouts are the compound catalyst of the 4X compounding engine. And when paired with reinvestment, they quietly bend your financial timeline in your favor. Let's talk about the move that changed everything for me. Everyone wants to feel smart when they invest. They want to nail the perfect entry, dodge the dips, sell at the peak, and brag about it later. But here's the uncomfortable truth. Market timing feels tactical, but it ruins results. Because even if you get it right once, can you do it again and again over 30 years? Most can't. What actually works is the opposite of flashy. It's boring. It's called time in the market, and it's one of the most powerful forces in the 4X compounding engine trademark. Let me show you how powerful. Let's say you invested $70,000 in VO, a Vanguard ETF that tracks the top 500 US companies, and another $30,000 in Apple. Now you don't touch it. No buying dips, no panic selling, no trading. Just let it sit. After 10 years, that portfolio quietly grows to $268,000. Respectable. But by year 20, it accelerates. Your $100,000 becomes $6.3 million. And by year 30, $58 million. No leverage, no options, no guessing. Just staying invested in quality assets and letting time do its job. Here's where most people mess this up. They get spooked during downturns, try to wait for a better entry, or sell after a run-up thinking it can't go higher. But history shows this clearly. Missing just a few of the market's best days can erase years of gains. The real move? Pick great assets you want and hold. That's it. Ignore the headlines, mute the noise, and stop treating your portfolio like a casino. You're not supposed to outguess the market. You're supposed to own it and let time do the compounding. This is the passive engine of the 4X compounding engine, and it's how everyday investors end up building generational wealth without breaking a sweat. This next strategy is a game changer if you don't have a big lump sum. Here's one of the most common traps I see. People think they need to save up before they can start investing seriously. They wait for a bonus, a raise, or some magical future moment where they'll finally have enough. But here's the hard truth. Waiting kills compounding. The market doesn't care if you're rich. It rewards consistency. That's where dollar cost averaging becomes a superpower. It flips the question from how much do I have to how often am I showing up? Let me show you what this looks like in real life. Imagine you start with $60,000 invested across DGRO, a dividend growth ETF, and Procter & Gamble, a rock-solid dividend stock. But here's the real power move. You commit to adding $1,000 every month, not when you feel like it, not when the market looks good. Just $1,000 every month, no exceptions. Fast forward 30 years, and guess what? That rhythm turns into $4.4 million. That's not lottery money. That's not wild trading. That's just the math of consistent, emotionless investing over time. And here's what people get wrong. They think $1,000 a month is a lot, so they wait. But here's the kicker. Even $300 a month starting today beats waiting 3 years to start with a big lump sum. Why? Because compounding is a game of time, not timing. So here's your move. Automate your contributions. Set up an auto draft, forget about it, and let the flywheel spin. You don't have to outsmart the market. You just have to show up on schedule. This is the contribution flywheel, and it's the third engine in the 4X compounding engine. Small moves made consistently that compound into financial freedom. Okay, now let's talk about how your income can grow on its own. Chasing high dividend yields might feel smart until it isn't. Because here's what most people don't realize. High yield doesn't mean secure income. In fact, it often signals the opposite. A stock under pressure, a company stretched thin, or a payout on the chopping block. If you want your portfolio to not only grow in size, but also generate income that rises with time, the smarter play is dividend growth. Consistent, compounding, and dependable. This is where things get exciting. Let's say you start with $60,000 in NOBL, an ETF made up of dividend aristocrats, companies that have raised their payouts for 25 plus years. Then you pair it with $40,000 in Microsoft, a tech giant that not only grows fast but increases dividends year after year. Now here's what happens when you let those two sit and work for 30 years without adding a single extra dollar. Your portfolio grows to $51 million, but more importantly, and this is what people miss, your annual dividend income climbs to $280,000 a year. That's not just capital growth. That's lifestyle changing, inflation fighting, freedom producing cash flow. And you didn't have to chase risky stocks or time the market. You just owned great companies that consistently raised their payouts. So here's the rule. Don't chase the highest yield. Chase the most reliable growth. Mix dividend growers like NOBL with long-term compounders like Microsoft. One gives you stability and predictable increases. The other delivers capital appreciation and explosive dividend upside. This is the Income Accelerator, the fourth engine of the 4X compounding engine. It's how your income grows on its own, like while you sleep, travel, or just live your life. Here's something you might not be thinking about, but should. Here's a silent killer of wealth that doesn't get talked about enough. Inflation. It doesn't crash your portfolio. It doesn't show up in red numbers. It just slowly erodes your purchasing power year after year. And if your income stays flat while prices rise, you're not standing still. You're moving backward. That's the problem with fixed income. Whether it's bonds, CDS, or even a rental that doesn't raise rents, it may feel safe, but over 20 to 30 years, that safe income becomes dangerously outdated. Now, here's where dividend growth flips the game, because it doesn't just give you capital gains, it gives you an income stream that rises over time, often faster than inflation. Let's look at the numbers. The U.S. inflation average over the last 30 years has hovered around 2 to 3%. But many dividend growth stocks, especially the ones in ETFs like NOBL or companies like Microsoft, consistently raise their payouts at 10% plus annually. That means not only are you keeping up with inflation, you're widening the gap between your income and your cost of living. And that's what real financial resilience looks like. Here's where people mess this up. They get attracted to safe 5% fixed returns and think they've won. But 10 years later, that same $5,000 a year can only buy what $3,800 used to. Meanwhile, the dividend investor collecting $5,000 in year one, they're now pulling in $13,000 from the same portfolio, just because they focused on growth, not yield. So here's the rule. Prioritize investments with a history of raising payouts faster than inflation. Look for dividend growers with 10 to 20-year track records of increases, and make them the backbone of your income plan. This is how you protect your future lifestyle, not just your capital. This is the inflation shield, the part of the 4X compounding engine that keeps your income strong and your freedom intact, no matter how expensive the world gets. All right, now let's stack it all together and make this system work. If you've made it this far, you're already ahead of 95% of investors. Because now you know the truth. Using just one compounding engine limits your upside. Most people stop at one. They turn on DRIP or make monthly contributions or focus on time in the market. But here's the unlock. Real wealth isn't built from one compounding lever. It's built when you stack all four. Let's break it down. Take a base of $100,000 and apply each of the four engines in the 4X compounding engine. DRIP, every dividend reinvested automatically. Time, holding quality assets for decades, untouched. Contributions, adding monthly fuel, no matter what the market does. Dividend growth, focusing on rising payouts that beat inflation. Now let that system run for 30 years. No timing, no guesswork, no trading. And what do you get? A portfolio that grows from $100,000 to over $58 million. That's not hype. That's the math of real compounding. Layered, consistent, and unstoppable. Here's where people mess this up. They use one engine and wonder why they're not accelerating. But when you layer all four like gears in a machine, the system starts working for you, even while you sleep. So what's your next move? Build your 4X engine blueprint. Don't leave it to chance. Don't rely on memory. Pick one strategy you're missing right now and activate it today. Before you click away, imagine two futures for yourself. Now imagine this works. Imagine you start today, and 5 years from now, your wealth and your income are compounding quietly in the background, while others are still guessing. Now imagine the opposite, that you delay 10 more years. You tell yourself you'll start later, and when you finally do, you realize you've missed the one thing compounding can't give back: time. Because here's the truth. Freedom isn't found in fast trades. It's built quietly, month after month, while everyone else panics. So if you're ready to get serious about your future, here's what to do next. Subscribe to Dividend Hustle for weekly systems that build long-term wealth. Comment below which of the four engines you're missing right now. This is Mark. See you in the next one.